Thank you to everyone for being here, and hope we'll be able to give you a few thoughts. It's interesting times we're in, and plenty of things to be paying attention to in the markets these days. So just to go over, there are a couple of things. If you are participating by a video on your computer or your smartphone or tablet, there is a panel that you can use to raise your hand if you have a question. To be as we get later in the talk, we've planned some initial comments to share, and then subsequently we will share additional content that is some questions we've received, and then we will ultimately open things up. So you would want to raise your hand if you'd like to be able to ask a question, and that way we don't have as much background noise. I don't know if you've done this before, but invariably if we have everybody on the line at the same time, it can create a lot of background sound, and it makes it a little harder to hear. So with that said, we have a little bit of a plan to get started. Joining me, I've got Brian Regan, our portfolio manager, with me, and Mike Perna is also on the line as well. Mike, are you unmuted? Can you comment? Not sure he's unmuted at this point. Let me see if we can make sure he's able to comment if he should want to. Does look like he is unmuted. So Mike, maybe text me if you have a problem, if you're having any challenges. In the meantime, let's get started. Brian, you've prepared a number of things for us to talk about, but I want to just give people some context before we get started on the agenda here. Today was an unusual market where we had trading issues. Trading halted a couple of times throughout the day. This is not the norm, but in very scary times, very volatile times, it can happen. We've kind of got a combination of things happening with a little bit of not only the anxieties surrounding the coronavirus, but also some things related to the oil industry as well. So we'll talk about some of those issues today. You can see here our overview. We're going to talk about the coronavirus, some of the impact it's had around the world, some of our thoughts going into the quarter, and where there have been some good and bad things happening in client accounts, some of the portfolio strategies we've been implementing. Talk a little bit about what's happening with China and how that might impact supply chains, and that could create its own economic disruption. And then we'll share some thoughts about questions that may come in and how it is what our perspective is throughout the content here. So with that, and by the way, if you do ask a question, bless you. If you do ask a question, we are recording today's content. So if you do ask a question, it would be assumed that you give your consent for us to retain this and potentially post it on the website, which we may do. Okay, let's jump in. And to start things off, we've seen a real escalation of the number of cases. Brian, you've been tracking this very closely, specifically the number of cases, yet maybe this number sounds a little more scary than it actually is. Is that right?
Yeah, you'll see on the next slide, we have active. This is the number of cases that have been reported.
So the 100 and change thousand is reported. I do think it's important for us to recognize the reality that there are other issues at play here, and that testing may not be as active as we'd like it to be presently in the United States. It's probably likely that the number of cases are going to increase during the next couple of days and weeks, but usually when we talk about cases versus confirmed active cases, it seems to be that the cases that we're testing the most are the most severe. And so that also plays into the concerns about what's the mortality rate associated with this disease. And at this point, I think because we're only hearing about probably or testing for where there's the most severity, there may be some explanation of how many people have the virus, and it may make the death toll look a little more severe than it actually may be. Well, in any case, we don't want to downplay it altogether, but we don't want to overreact either. Let's turn our attention to how things came into the quarter. Brian, you want to walk us through this?
Yeah, I just think it's important to revisit where we were at the beginning of the quarter, because if you followed our webinars or went to our live event, you know that valuations were certainly stretched versus the historical norms. So we had a forward price to earnings ratio of 18.43 going into the quarter. So, a little bit of a correction was probably expected based on the general overvaluation of the market.
And certainly that's been the case.
So that chart was from the beginning of the quarter. This one's also from the quarterly webinar that we did. We did invest a little bit more in stocks as we came into the quarter pretty underweight, and we added on average, I'd say a 4 or 5% position of international exposure to most portfolios, and the reason being is we had some political headwinds go away, and the international market was significantly cheaper than the domestic market. And I bring this up because we've seen it actually hold up pretty well in the face of the coronavirus. I think before today it was actually outperforming the domestic market, but they all fell in unison today.
All right.
So here's the picture of where we are as of March 6th. So this doesn't even include today's debacle. You can see that if you look at the far right of the chart, in the chart at the beginning of the quarter, we were at a forward price to earnings ratio of 18.43. Now we're at 16.7. So if you followed along in the webinar at the beginning of the quarter, we said that we expected some of this stuff could happen. The sell-off could happen if earnings didn't come through. So coronavirus and some oil shocks are definitely going to affect earnings from corporate companies. So the sell-off is, I wouldn't say totally unexpected, but definitely more severe than what would typically be still in a correction.
Yeah, and I think we put out some commentary. How long ago was that? A week and a half ago, something like that, maybe 2 weeks ago. I've lost track, but the original hope was that some of the impact of this would be more modest, and that there might be just some containment of the spread of this coronavirus in our midst. I think at this point we can expect containment is not probably all that likely, and that it will continue to spread to some extent throughout the United States, and that will create some further impact on just as we're seeing in other parts of the world where there's some consequence to this, but not to be overstated either.
Chris, can you just go back to that slide real quick? I just want to make one final comment.
Yes.
So the one final thing I want people to pay attention to is we are coming in line with the 25-year average of fair value. So, we probably are there today, but I do expect some earnings revisions. So that's probably going to push that, the market down, could push the market down a little further. But you should see some kind of support before you hit that 1 standard deviation down, just like we saw some, a ceiling when we were close to 1 standard deviation high.
That's a great point. And, as much as we may see some earnings revision and that may cause this, where exactly is that 16 times kind of number? That'll be the art of trying to identify where's fair value.
Sure.
Fair enough?
Yep.
All right, so stock market sell-off and bond rally. Let's talk a little bit about what's happened. Was this something we're going to have Mike speak to? Did Mike get his audio working?
Yeah, Mike. Looks like he's still MIA.
I can see he's on the call. Just sorry, Mike, we can't hear you. So anyway, go ahead.
So the next few slides here, what I'm trying to lay out is I bring up 4 different asset classes, and I'm trying to lay out how a diversified portfolio, buffered the reaction to the dramatic stock market move that we've had. So this is a chart from March 4th. You can see that we had a pretty big fall from the February 19th high. At that time, it was 11.2%. After today, you're looking at north of 18% down. So pretty significant move that we all know.
Okay. Oh, sorry, I think I went more than one. Oh, there we go.
So this is the international market, and you in my comments earlier, I mentioned how it had held up a little bit better. So it was only down, 8.36% over the same time frame that I showed the S&P 500. So about 200 basis points better, 2% better. Again today they both kind of fell in unison, down about 8% each. But generally speaking, I think there's been the impression that all international stocks are just going to continue to trail domestic stocks, and valuation isn't going to matter. I don't really think that's going to be true in the long run, and I think in a market sell-off like this, where you see the international markets hold up a little bit, you see that's true. There are more risks in the international markets when you come to crisis, and it's something that we do need to keep our eyes on.
Yeah, I mean, what to expect going forward. Part of the reason you have this is for diversification. There are different risks in different economies, and how we think about this is subject to change going forward, basically, right? We started the year thinking foreign markets offered, less extended valuations. They actually looked a little bit cheap. But at the same time, we'll have to see how some of these markets are subject to recent events, and how that's going to affect them going forward. We have had a gold position for a few quarters now, and fortunately that has been helpful in the impact on the portfolio. You can see in this scenario, although gold did have a little bit of a disruption temporarily, it's really come back pretty sharply. Brian, how recent is this slide? This was as of a couple of days ago.
A couple of days ago, but year to date, gold's up 10.5%.
It's actually even a little better than this slide presents. So it's been a real bright spot, a shiny bright spot for us in our portfolio, perhaps.
Yeah. I like the pun there.
Yeah. Thanks. So anyway, I think one of the things we've intentionally done is tried to mitigate some of the exposure to stock because of those valuation concerns. And we included gold as a risk asset, but one that moves differently from stocks, intentionally for the concern that it could help in times like we've had. And so, fortunately, it's been a help, along with other risk assets that are designed to mitigate risk, which brings us to talking about our bonds, or bonds generally. Brian, why don't you comment about bonds?
Sure. So this is just the aggregate bond index. It's mostly comprised of investment grade bonds, and you can see that it's also done very well over the last year. So really the point I'm trying to make with all 4 of these charts, and that Chris is trying to make, is that if you have a well-balanced portfolio, you're going to get through this okay, and you've been a little bit buffered. And, before today, in our more conservative strategies, we were even seeing some positive numbers because, we were able to be well diversified, which is the key to the game. You should never pull your goalie, as some people like to say. Always make sure you get somebody playing defense in your portfolio.
Excellent. I do see Mike is on the screen. Mike, is your microphone working as well? Can you be heard?
I think so. Can you hear me?
Yes, we can. Very good.
Okay.
So we just went through some of the section with the graphs. I didn't know if there's anything in there you wanted to specifically comment to before we move on to our next section.
Well, Chris, I've, been following the market very closely, as I know you and Brian have. And it's still, a mystery to me why the market has reacted, so sharply to the issue of the coronavirus. There's an old saying that goes like this: the market goes up on an escalator and comes down on an elevator. And I think there's a lot of truth in that, bad news tends to get exaggerated, and the reaction to bad news, is more dramatic probably than it should be. My thought here is that we haven't reached the point yet where people are, they're stopping, they're running and turning around to look at what's going on. They're just running. So probably this week we're going to have more pain. But I think, at some point, maybe next week, the bleeding is going to stop. And we're going to take a look and see what the true impact of the coronavirus is. Everywhere I turn right now, I'm, reading about, different attempts, to, cancel meetings and cancel concerts and any place where a large number of people gather. And I can understand the logic, but in today's society, anywhere you go, if you go alone, you're exposed to, millions of people, even if you walk down your street, because everybody today travels and works in different places, and they've interconnected with hundreds of people who've interconnected with hundreds of people.
Yeah,
So,
good point. And, I think to your original comment, as far as like some of it's a mystery, and yet, I think this just happens to be the catalyst, at least in some of the initial decline of the market is in part due to the concerns we had entering the quarter, that markets were a little extended, not entirely justified by the earnings that they've been generating. And either we had to see earnings improve, or we had the risk that markets could decline some. Or was our hope that we might see some escalated earnings to justify the levels and further extend them. But that was why we entered the quarter in a, modestly more cautious posture for many of our strategies that we managed. But to your point, let's talk a little about some of the challenges of an interconnected world, and specifically how this might impact the U.S. economy as it relates to some of the challenges we've seen in China, and how that influences the U.S. economy potentially.
now, before we go in that direction, Chris, let me just say this as well. Even last year, at the end of the year, you and myself and Brian, we're talking about an expected slowdown in the stock market. Last year, we were up 29%. And we had felt at that time that we wouldn't see anything remotely like that. And in fact, we might expect a pullback. And I think that for a long time, a certain momentum has been building, okay, to expect, okay, a recession around the corner. And it never came, okay? But the first sign of trouble, okay, unleashed the floodgates. And now we're dealing with the deluge. So I think a lot of it is expectations. But as I say, at this point, no one has really stopped running, okay, to turn around and see exactly what's chasing them. And therein lies, what I believe will be the turning point when the general public stops running and faces the problem and see exactly where we are at.
Okay, very good. Brian, do you want to take this slide, please?
I'd love to. So, Kathy Ingersoll, our director of marketing at AMR, relatively new, but many of you might have met her. She was asking some questions about supply chain activity and possible disruptions that there could be, and I thought it was a very good question. So the reality is there isn't much data yet on the impact of the coronavirus, but I dug up what I could and what's available, and one of the things that is available is China PMIs. So this is the Purchasing Managers Index. We talk about this pretty regularly on the quarterly webinars. It's basically a measure of manufacturing activity in China. And the red line, you can see the difference in readings. Over 50 is good, and it dropped from 50 to 35. This is pretty much an overnight drop. So it's quite clear that there's a slowdown in manufacturing activity that's going to slow down all the end parts that end up on United States shelves.
So, I think that's inevitably going to have some slowing effect on U.S., whether it's manufacturing or, retail and so forth. There's going to be some overflow from the disruption that we're seeing in China. And then add to that prospects of if there's, this outbreak in the United States or other parts of the world as well, it could have similar kind of impact where things could become a little bit more disrupted if, the behaviors are being changed. That is to say, we'll talk about some of the industries that are more likely impacted by this directly in the short term, whether those are long-term disruptions, but there are likely to be some, at least intermediate, impact from this. Sorry, just you want to continue on talking about some of the supply chain?
Yeah, so like I said, there's not a lot of data, so I grabbed as many anecdotes as I could find. Microsoft said that they might be hampered for getting parts for laptops and tablet computers. Toll Brothers said they were going to have difficulties getting lighting parts. MasterCard pretty quickly came out and cut its growth forecast. Amazon and Nestle also came out and suspended international travels for employees. So you're starting to see some companies come out and saying they're having issues. Dell Computers had problems with their supply chain in Australia. Apple has kind of had mixed reactions with the way that they have been messaging their problems. They say things aren't great, but then they're optimistic, and then 85% of their supplies are underway. So they kind of mixed messaging from Apple, which makes you a little bit more optimistic. And Volkswagen as well said that they expected deliveries to be in line with 2019. So I'd say there's some mixed messaging here, but obviously things aren't smooth. And one of the things that you notice with that happens pretty consistently with supply chain disruptions that people should know is there's something called the bullwhip effect, which basically causes excess costs throughout the supply chain. Which can hurt corporate earnings. So that's just another headwind to the operating margins that the economy's already been facing.
And counterpoint, Brian, we've seen the price of gasoline drop below $2 a gallon, right? And in addition, interest rates have fallen. So those should be two factors that would tend to mitigate many of the problems that the supply chain slowdown has brought forth. Now, are they enough to turn things around? As I said earlier, I don't think until we really, start to understand the impact of the virus and what can be done to contain it, that we're really going to see a return to, a rising market.
Perhaps we can talk a little more about interest rates and the oil industry in just a few minutes. There's some additional slides we're going to talk about some of those issues as well. So let's come back to that because those are great points.
I thought this chart here was particularly interesting. So this is basically the carbon dioxide or nitrogen dioxide levels in the atmosphere in China, or pollution in the atmosphere in China. And you can see the difference from January and in February here. It's just another indicator of how the production facilities in China have really slowed down. Maybe good for their air, but bad for their economy.
So what are some of the ways in which this has had some impact or is likely to have some impact? As you said before, Brian, it's really early to know for sure what will really be the economic consequence of this or the GDP impact. What are we looking at here, and how does this? This is all about expectations going into the year, I think, right?
Well, the OECD lowered their projections for world growth from close to 3% down to 2.3%. So that's a pretty significant move.
Yeah.
And a lot of people consider that a global recession when you get down that low. The actual definition of recession is 2 quarters of negative growth. But when it comes to global growth, the 2.0 to 2.3% mark is considered a global recession. So it's something to keep an eye on. Obviously, this is just a forecast, but these people have some really great data that I try to rely on because they're pretty reliable.
Clearly, the Fed took action in the last week. Clearly, there's an expectation there's going to be some adverse economic impact in the U.S. and that there's an effort at the Fed to try to mitigate some of that impact by offering more stimulus. And so this is a scary little chart to show the degree of significant decline in auto sales in China. And clearly that's going to have some impact on U.S. companies as well.
Well, I think it's a exaggerated case of what we're going to see everywhere else because they basically shut down everybody. They had basically martial law in a lot of provinces in China. So you saw the economic activity slow to a halt as they were getting this thing under control. And you can see this is really wreaked havoc on the auto industry. I just pulled the Ford chart here just as you could pull a similar one for GM. Certainly you can for Tesla since it's fallen from its highs. And this is even lower. It says 697 when I pulled this. I know it has a 5 handle today. So the auto industry has been significantly impacted. And what you've seen is most capital intensive industries have been really impacted by the effects of this virus.
Well, clearly there's other industries that are going to be influenced by this, whether it's the cruise industry or you've identified the travel industry here.
Yeah, so I pulled some information about American Airlines here and how they've canceled a lot of international flights, as one might expect if you're not trying to spread the virus. This is American Airlines. I chose it just because it's one of the biggest airlines, and the next slide shows the impact on their stock. You can see, I also pulled Delta Airlines. It's a little bit of a better company than American Airlines, and you can see the differences.
Just as an aside, I got an email from United talking about how their filtration system on all their flights is, top notch and so forth. They were trying to put people at rest about some of this.
I had something similar from Delta, actually.
Yeah.
Yeah, so you can see American Airlines is sold off on 41% when I pulled this. I'm sure it's much worse as of today.
Right.
Delta, it's a significantly better company. American Airlines has all sorts of balance sheet problems and quite frankly, borderline accounting ethical issues, I'd say. Delta, much better company. It's only fallen 22%. I'm saying 22% like it's not much. Yeah.
But by comparison.
Right.
So naturally, Brian, people are starting to ask, when do some of these things represent opportunities? And, I think when you start looking at companies, industries like the auto industry or the cruise lines, you have to be very questioning when's the right time to do that. It may not be the right time to be thinking that way just yet.
Well, I was never really interested in the cruise lines. We own Ford in the individual stock portfolio, and I recently moved out of it because Ford's issue and what their issue has always been is they're a bank and a car manufacturer. So if they have their credit lowered to below investment grade, which they're at BBB right now, they could have significant financing problems, which is why I think you've seen their stock sell off even more aggressively than you might imagine, given their assets. But to answer your question overall, I do think the market's definitely, throwing out some opportunities to buy. And when we get towards the end, we'll see some of the responses that actually this next section, some of the things that we've done.
All right, so let's talk about that, and it'll tie into some of those kinds of questions ultimately. Just using one of our strategies as a framework to kind of give people some context. You've highlighted the 50-50 here, our simple strategy, which is a mutual fund and ETF strategy that we use to when we offer managed strategies for clients, among many others. But in this strategy, we went into the quarter positioned with a little less than 50% in equities. You can see here between the U.S. and non-U.S., we're a little underweight. If you take into consideration other, a portion of that is going to be our gold exposure, and which we consider to have volatility, not unlike a stock in many respects, but not in the same way stocks move. It's likely somewhat uncorrelated. And so we had that intentionally as a means of trying to mitigate risk. And our bond positions were pretty conservatively positioned as well. No high yield exposure to speak of. A little bit of bank loan type positions, but overall we're a little bit underweight market exposure. Do you want to continue on with some of the highlights here, Brian?
I think you really nailed it. The bottom line is we were positioned relatively defensively for the market going into this, which I think is the best thing you can do. We preach our active allocation process, and I think it put us in a good position to be relatively defensive when the market was expensive.
It's important to keep reiterating that notion that we do have what we're calling an active allocation process, which at least quarterly we are revising and reviewing based on economic outlook, economic data, where there might be opportunities, where there might be reasons to be more defensive. And so, going into this quarter, we have been a little more defensive in structure because of that process. And that, I think, has been important and helpful in our posture going into some of these challenges we faced over the last 3 weeks or whatever it's been now. So that's not to say that we're immune from volatility. We're subject to it as well, but we have been a little better positioned. Why did you pick the 85-15 here to reflect some activity here, Brian?
So on March 3rd, after a significant decline, the 85-15 is one of our more aggressive strategies. And I decided to buy a little stock in the decline. And we had done really well in gold, and our dividend leader was falling behind a little bit. And what we did was we just trimmed gold. There's still a position there, but then we bought some stock. And the idea here is that with some smart systematic rebalancing, when the market recovers, the portfolios will be in much better shape.
And I think it's important maybe to talk about that idea of some smart systematic rebalancing, that the phrase you used. How will we be thinking about that going forward? I think it's important to tell clients that, we do look at the occasions like we're in the midst of as something to be at the right time. And of course, we don't have a crystal ball as to when the bottom of a market is, but periodically throughout this kind of experience, we may want to be doing some rebalancing, which is a forced discipline to sell some of the things that have done well and buy some of the things that look a little bit cheaper today, so that when we do have a rebound, we're getting some of the benefit of that on the upside. And, that we're consistently trying to tweak those numbers a little bit. Fair enough?
Yeah.
Okay. Tax harvesting is also important in taxable accounts. Losses are never something anybody enjoys. Let's face it. We want to avoid them as much as possible. But there are opportunities sometimes when we have declines in taxable accounts to sell some of the positions that might have gone down, realize those losses, and replace them with very similar positions that can enjoy the upside when we rebound, but can give us the opportunity to bank some of those losses for later on when we might want to offset future gains. So, Brian, how often is this done, and how do you approach it?
Well, we always do it towards the end of the year. There wasn't a lot of losses last year because the market did so well, as Mike was mentioning. But when you have a giant sell-off like this, it's an opportunity, a risk-free opportunity to lower everybody's tax bill for 2021. And it's really a no-brainer to try to take advantage of it whenever you can. When the market's marching higher, which is 80% of the time, the opportunity is not always there. But this was a golden opportunity for us.
Excellent.
I think probably most of our clients are going to enjoy a little bit of a tax benefit, at least from this pain.
Well, we do, Brian, have some people who also have our individual stock portfolios on the line. Do you mind elaborating on some of the things happening in the individual stock portfolios that we have? We mentioned the simple strategies, which more of our clients would have, but certainly some do have the individual stock strategies.
Sure. So the story is pretty similar, and it's like that on purpose. But there's a lot of opportunities in individual stocks that there might not necessarily be for ETFs and mutual funds, just because it's a more dynamic kind of strategy. So we came in again in defensive positioning with over 8% in cash going into before the coronavirus. We had a tilt toward value and blue chip positions, but we were diversified in all risk buckets. So what do I mean by that? I mean, we had fast growing stocks. We had what I consider stalwarts. We had slow growing stocks. We had cyclicals. We had some asset plays. We even had some small speculative positions. So I thought we had a very defensive but diversified portfolio filtered with opportunity and risk mitigation.
So most people probably have this with a combination of some stocks and bonds, but in this case, you're illustrating a all stock version of this.
Yeah. In fact, I think everybody has it with a mix of stock and bonds. So, like I said, there's some more dynamic opportunities that represent themselves, and when you come into a situation like this with over 8% in cash, well, you're in a good position to do some buying, and that's basically what we started doing when we saw the prices start to collapse. and we saw some opportunities start to show. We haven't really realized a lot of the opportunity that we thought was there yet as the market continues to fall. But again, I think, buying stocks that with the great valuations in the long and even in the medium term is going to be the best strategy for you. So, we bought something like a B&G Foods, which is a pretty good recession type stock with a high dividend. We bought things like Raytheon, and Raytheon is a blue chip defensive manufacturer, the kind of stock that I dream of buying if it gives me a fastball down the plate. So we were able to get a position into that. And then once we got some nice new names in the portfolio, it was about buying the best of the best. So we bought more Facebook, more Raytheon when it fell further, more Ultra, more Berkshire Hathaway, more Broadcom on 228 and March 2nd. And if you look at the charts of those stocks, those prices actually fell lower that day than they finished today in a lot of cases, especially in the case of Berkshire Hathaway and Ultra, I believe, and Apple. So we bought more Apple that day too. I don't know why that's not in there. Like I mentioned earlier, that we sold Ford at 677 due to some balance sheet concerns. Replaced it with Universal Corp. It's a dry tobacco distributor with a great balance sheet, and I'm expecting a 6.5% yield. So we can expect a nice stable rebound from that stock rather than the roller coaster we're probably going to get from Ford. So, this is kind of what the stock portfolio looks like today after making some changes. You can see that we invested a lot of the cash, but we're still down to about 3% cash. So there's still some cash there if we really get a nice fat pitch to swing at. I'm really looking at things like Visa as a good opportunity that I'd love to get into. Because we bought the sell-off, we have less cash. And we have less of an allocation of value and more towards large cap blend, which is kind of on purpose because I was buying those high quality blue chips as the stock market fell.
So we invited people to ask some questions, and we did receive a couple in advance of our gathering today. But for those who would like to ask a question, we've had a couple of comments that we'll go to in just a moment that were in the question and answer section. You also could raise your hand if you'd like to be unmuted, and that's how I'll know to be able to unmute your line and give you the chance to ask a question. But that being said, we did have a question about, should we be buying some of the companies that might benefit from the disruptions created by the coronavirus? Been quite a few people thinking along these lines. Is there a chance to be opportunistic and pick up some upside as a consequence of, extreme purchases of Purell and wipes and masks and the like? Brian, you had outlined some response to this for us. Take it away.
Yeah, I mean, the bottom line is we own them in most ways. So in the ETF mutual fund strategies, they're being held in ETFs. So we haven't been taking a lot of risk in the growth side of things because we were being a little bit more defensive, as we were talking about earlier. So in your low volatility strategy and certainly your healthcare, you're going to see a lot of the names that you would imagine would be with masks and vaccines and Purell and wipes. XLV is the healthcare ETF. It's in most everybody's portfolios. In the individual stock strategies, with the diversified ownership, you want to come into a crisis like this with a diversified portfolio, so you're already going to own some of those names. So we already own Pfizer. We had bought Barrick Gold on a dip. We had bought B&G Foods at the beginning. Berkshire Hathaway has $120 billion in cash. I think that's a great stock to own in a situation like this. We came into this situation owning that. Costco, we came into the situation already owning that. So bottom line is it's better to come into these crises with an already diversified portfolio. And buying more kind of destroys your diversification benefit. A lot of folks ask us to buy their favorite stock in an ETF mutual fund strategy, and we usually tell them that we don't like doing that. And the reason for that is you just kind of destroy the account takes on the risk of that one individual stock. Chris, could you go back one more slide?
Oh, sure. Had more to say on that.
Yeah, and the last thing is chasing the stocks is usually a bad idea. When the crisis is over, the stocks are going to crash because it creates a when to sell problem. And to me, that's more like gambling than investing. That's like when Bitcoin was running to the moon, everybody thought you should be buying Bitcoin until it fell from 20,000 to 4,000 overnight. So it becomes a when to sell problem. The other thing is one-time gains are usually adjusted and discounted by investing professionals. So it might seem like, hey, look, they're going to have a great quarter, but the people who are analyzing stocks and buying stocks are looking for longer-term, consistent profits rather than one-time quarterly gains. So it's going to be just a discount in the market.
So maybe a momentum play, but it could create problems for you ultimately. Yeah, that's a good point. So one of the other questions that has come up is how similar is 2008-9 to our current conditions? And I think there are some pretty significant differences that 2008, 2009, we really dealt with some systemic concerns. Whereas, the situation we have now are more situational concerns. Go ahead and walk through these points as well, Brian.
Well, I think you really summed it up nicely there. And when it comes to systematic concerns, it's really about, is there liquidity in the market? Right now, it seems like there is enough liquidity to at least keep the markets running as normal. Today was a bit of a shock to that. You've seen the Federal Reserve step up with a rate cut, a repo facility with primary dealers. So they're putting some support and making sure that, generally speaking, the credit markets work as normal. We're going to see some higher risk corporate credit bubbles burst. New issuance is going to be very difficult, and there's going to be a lot of generally small cap, general energy materials companies have a lot of trouble continuing to finance themselves. What's to watch for? I mean, I guess this could turn into a situation that could be bad. I mean, you don't see markets sell off 8% in one day because everything's rosy for sure, right? So you need to pay attention to the international markets that require dollar funding. So if governments can't refinance themselves in dollars, which is going to become, which is the asset of the world, but it's going to become even more important during stressful times. You want to see the Fed come in and influence it with 2008-09 tools. So, there can be central bank coordination. They can do dollar for foreign asset swaps, things like that, that can help provide funding to international markets. You want to keep an eye toward international bank health, primarily in Europe. This is primarily in Europe, but I think this is also community banks. The Fed does a good job of keeping primary active dealers in their networks to influence policy, but they're going to need to give access. They're going to have to give access to a lot of banks that could come under pressure if you have some significant credit problems. You want to actively look forward to the Federal Reserve for lending facility swaps and open market operations. If we hit the zero lower bound, for example, the next step would be something like quantitative easing. I mentioned the use of swaps and lending facilities already, so I won't dwell on that.
So we have one other question I want to make sure we speak to about what happened today. We've kind of touched on it a little bit. Oops, sorry, just hit the button twice there. Would you mind talking about what's happening in oil and why that seems to be potentially a disruptor for the market today?
Yeah, basically Saudi Arabia and the rest of the OPEC nations were cooperating with Russia and what they were calling OPEC Plus to manage oil prices, and that's why you were kind of seeing it consistently over 50. Also because it's the general marginal cost to produce in the United States. But Russia basically told Saudi Arabia that they no longer liked their agreement, and they were going to continue to produce oil, without a cut in oil high. And Saudi, which is the lowest world said, okay, now we're in a price war with you. We're going to fight over market share. And that really sent oil futures tanking. And it was the start of the sell-off today.
You kind of mentioned credit markets and, liquidity concerns that have come up. There's been a lot of discussion about this over the years, but high yield bonds and oil kind of go hand in hand. Do you mind, in terms of some of the impact that can have? You pointed out, I think one of us pointed out that our portfolios have been light in high yield risk. We've really eliminated it from our portfolios over the past 6 months to a year. And I know over the last week or so, there's been some significant changes in what's happening in the high yield market. Spreads had been very narrow between treasuries and high yields, and things are changing. Do you mind talking about that and connecting it to what's happening in the energy space as well?
Sure. So 12% of the high yield market is energy. If you remember back in 2013, 2014, 2015, when last time oil prices were around $30 a barrel, you saw some pretty big names slip to high yield too, like Glencore comes to mind. It's a big part of the United States economy now, in the credit markets, not really in the stock markets. And it's going to have some significant impact on where you see yields go in that market. We haven't been in it, like Chris said, because it was just getting really expensive, where the risk and return trade-off didn't really make any sense. We know that a lot of registered investment advisors, RIAs, were in high yield as they were stretching for yield, and it worked out for them for years until now it's really not working for them at all.
Thank you. Let's see, we got one other item here that we wanted to hit on. Have we had sell-offs like this before? And clearly, this isn't the first time.
It's the 11th worst day ever, which is pretty significant. But right. we were down 22% on Black Monday in 1987. So, the world moved on, and the market grew pretty significantly since 1987. So, I think, and if you take a longer term view, that's probably going to be the same situation we're going to be in after this one.
All right, so we did have a few questions that people had raised earlier that were off on the written content. And by the way, we'd be happy to have someone who wants to comment or, just let me know and I'll unmute your line. One person, we had David Dow had mentioned that as a retired marine scientist living on the Cape, which has lots of older people, I'm concerned that we lack the hospital or medical resources to address the coronavirus epidemic. Thus, I signed the Union of Concerned Scientists petition on why we need to use better science to solve this challenge. I don't know if David, if you had any interest in being unmuted, be happy to see if I can find your line. If you'd like to comment, happy to have you do that. Let me just see if I can find your there we go, participants. And David, I'm gonna set you up to talk if you'd like to. David, are you there? See if his line is unmuted. Well, David, can you hear me? All right, well, we will let that stand as it is. So there was something from Ron Parker, said, speaking of science, the growth factor for cases outside of China dropped just below 1 today. this is hopeful news. Also, the growth factor in the US has been about 1 for several days, effectively meaning the probability of infection has not increased during this time. Having said that, we are not accurately measuring the growth factor since we do not yet have enough test kits. Perhaps I can see if Ron would like to comment as well. I'll see if I can set him up to offer any comments.
Can you hear me?
Yes, I can.
All right. Well, this is a comment. I happen to be in sunny San Diego, trying to figure out when to go back. So I've been watching the growth factor pretty carefully, and as I mentioned, it hasn't been increasing significantly above 1, which is very good news. I think it could be that we're taking these precautions, unprecedented really in my lifetime even, in terms of trying to avoid crowds and conditions that would spread a contagious disease. So I mean, if you look at the data so far, you could say there's an overreaction, particularly in the United States. But on the other hand, these reactions are perhaps preventing the spread. So I guess I'm a little optimistic that at least in the United States, we'll get this under control.
Yeah, I think, Ron, I share a lot of the same sentiments. And I think I also look at this and say, clearly we don't have the testing the way we really would like to have it. And so as these tests have been going out over the last couple of days en masse, it's probably likely we're going to see some increase in numbers, where that may change the figures a little bit. But, I guess there's only so much you can do, and it probably is going to be a matter of behaviors will change to try to mitigate the risk.
Yeah, I mean, at the present time, it's actually pretty trivial, 50 cases a day. That's nothing.
Yeah, it's a good point.
And it's been staying there. So, but again, I wouldn't recommend everybody say, no more problem, well, business as usual. Obviously, part of this has to do with the fact that people are taking note of the seriousness of the potential spread of the disease. So it's all good.
Yeah.
Let's hope it stays that way.
Well, to that point, what we are doing going forward is inviting our clients, should they want to have meetings in person, or if they would prefer to have them by virtual meeting, we're going to make either approach, accommodated. It's easy enough for us to do. So, it's certainly not a problem to offer the, to offer that kind of an approach if it helps to mitigate the risks of exposure. So these days we've got tools that if people would want to, we can do a virtual meeting quite easily.
So actually along that line, I'm wondering if Brian has looked into companies like, I don't know who the parent company for Zoom is, GoToMeeting, all these, because it seems to me, obviously this is very popular right now for the obvious reason, but it could well be that people will find out they can work this way very effectively.
Yeah, there could be some sustained benefit.
And there might be,
I did see that
technology to invest in.
I heard this morning Zoom was trading at a high 20, I forget exactly what it was, but 24 times, 28 times, I forget now, multiple on its earnings. The particular analyst who was being interviewed was not as optimistic as to suggest that it was a great buy at this point. But in any case, I agree with your point that there may be behavioral changes that last, or at least revenues that sustain, that may make it worthy of looking at things like that. But to Brian's earlier point, well, Brian, you can make it yourself that, it's ultimately about sustained revenues.
Well, just before Brian speaks, I agree, but I think what may happen is people will find that they can work in ways they hadn't realized,
Yes,
and
I wouldn't
so
be surprised. I think you're right.
So that might indicate there would be some sustainability in companies like Zoom, but I'm no expert. If I were, I probably wouldn't be on the video with you.
Do you want to comment, Brian?
Yeah, I mean,
Thanks, Ron. Appreciate your comments.
on Zoom, I haven't looked too closely at it, but it just came public not too long ago. There's a lot of competition, so I've looked into Slack very closely. I almost bought it at 20. I wish I did, but I didn't because it didn't really hit the margin of safety. But that's a big competitor. Microsoft has something called Teams that's also a big competitor. I mean, we used to use a system from LogMeIn called GoToMeeting. It's all very similar stuff. So, there's certainly a lot of competition in the space, and we do own Microsoft in the individual portfolio. And if you want to know the underlying holdings in your ETF mutual fund portfolio, I'll tell you something like Microsoft is going to be prominently featured. So, we're not ignoring trends like that. It's just I'd rather own Microsoft than something that just came public and is arguably not profitable. I mean, there's a lot of adjusted earnings in that, but if you actually look at their GAAP earnings, I don't believe they're profitable yet.
I don't see other questions, so but if anyone does want to, as last chance on a Q&A. And in the meantime, I think what I would just try to do is offer some perspective, and that is that as it stands, what we're trying to do in the way we design your portfolios and the way we're implementing them is we are trying to look at the broader context of your financial planning, put things into what's an appropriate level of risk, what your cash flow needs may be, try to structure a plan that's functional and appropriate for your needs over time. And then in addition to that, try to pay attention to this active process that we have for looking at what are the risks in the world around us and try to posture the portfolio either more defensively or more opportunistically. And we will continue to be watching and making some determinations about what are the best things to be doing in the different kind of strategies that we have for the level of risk that you've indicated to us. I would also point out, though, for those who are nervous, as much as it may be, we've seen declines in the portfolios and, not too severe, but the markets as a whole have declined. If we put this into the context that, markets went up roughly some 300% in aggregate from, where they were 10 years ago to their peaks, and now have given up, the stock market maybe some 20% or so. It's not too late to consider if you don't have the temperament and you need to entertain some changes. Again, it doesn't have to be with the entire portfolio. Most people have more than one account. We can entertain changes and trying to plan accordingly for your needs. So if you have concerns, don't hesitate to reach out, and we can plan a meeting virtually or otherwise for how to address your particular needs. Mike or Brian, do you have any final comments?
Well, if I could, I just wanted to ask you guys what you think is going to stop the rout. What do you think is going to happen for the market to, stop declining and turn around?
Well, I think it'll become easier with more information. Right now there's a lot of speculation as to what's going to, uninformed speculation that's caused by a lot of anxiety. I think, the data will help us make some determinations about how to respond. Right now, it wouldn't surprise me if, as these numbers get a little worse from the coronavirus, how things will play out with this oil price situation and how that all these things have economic consequence. I don't think we've seen the last of some of the economic consequence. Whether or not markets will significantly go further down is anybody's guess. I think our expectation right now is to try to position ourselves in a way that we can be opportunistic when it appears that data is likely to start to improve. And with the way we structure things for our clients, we try to have reserves in their portfolios, and it may change how we think about our exposure to gold or to different aspects of the investment design, how we've structured the bonds and so forth. Brian, you want to comment?
Some kind of more near-term catalysts. So if Russia and Saudi Arabia come back to the table and come up with some kind of agreement, I think you'll see a pretty significant pop. And I think if you see some, slow down of the coronavirus around what, kind of what Ron was talking about there, I think you're going to see a pretty nice rally. I think, today was a pretty unusual day, but I think that you're going to start where everybody was just selling regardless, whatever it was, they were selling it. I think, some clear-headedness and some fundamental analysis is going to come back, and you're going to see,
opportunistic buyers.
Yeah, some opportunistic buyers. I saw, ExxonMobil was selling below tangible equity value today. People are going to come in and buy that. They might be waiting a little bit longer, but eventually it's going to find a floor there, just because it's too good of a company with too solid of assets to not find a floor. And I think that's probably going to be true for at different price levels for most of the market. But yeah, there's some near-term catalysts and some fundamental factors to play in.
Anything you want to comment about, Mike?
No, I've been around a long time, and this one's kind of new on me in terms of, worldwide virus. It's not something that I think is going to be resolved quickly. I don't think so, because I still don't think the magnitude of the epidemic, has been fully realized. So I think we're going to be in for some rough sledding for a while. But I think eventually, we'll get used to it. We'll learn to live with it. And, at that point, I think they'll see a market turning around. Looking at time frames is very hard. I don't think for the rest of this month we're going to see any kind of turnaround. But who knows? Who knows?
All right, to be determined. I think none of us know for sure, but I think the key is to try to keep our heads about us and to try to structure things in a way that gives us the best opportunity for good results.
I've been watching our portfolios, and my God, we have done quite well, vis-a-vis what's going on in the exterior. We were very proactive on this. So as far as, numbers go, obviously the numbers are down, but geez, we've done so much better than the general numbers out there. So that's very encouraging.
Okay, please do reach out to us if you have any questions or would like to schedule a consultation. If you have any kind of concerns, we're here to help, and we want to be available to you. Mike, Brian, thanks for your efforts tonight.
Thank you, Chris.
Thanks.
Okay, good night, everybody.
All right, night.